Welcome to Module 14, where we'll dive into strategic exit and enhancement strategies, focusing specifically on the disposition and renovation of income properties. This module is designed to help you understand how to effectively manage and increase the value of income-generating real estate through smart renovation decisions and well-timed exits. Throughout this session, we'll explore key techniques to maximize returns and minimize risks, setting you up for success in your property investment ventures. Let's get started. This module covers three key areas essential to the disposition and renovation of income properties. First, disposition strategies. It's important to assess market timing carefully and set clear exit triggers so we know the optimal moment to sell. We also need to consider the tax impact, including capital gains taxes, to understand how they affect our net return. Comparing a straightforward sale versus a 1031 exchange is crucial, as a 1031 exchange can defer taxes, but might not always be the best choice depending on your portfolio goals. Aligning the disposition strategy with your long-term investment objectives ensures everything moves cohesively. Next, value enhancement involves pinpointing renovations that effectively raise the property's value. The focus should be on upgrades that truly boost rent potential, rather than just cosmetic improvements. It's also vital to distinguish between capital improvements, which can add lasting value, and routine repairs that maintain the property. Prioritizing projects based on measurable return on investment helps ensure resources are used efficiently. Lastly, financial analysis ties everything together with a thorough cost-benefit analysis to compare renovation and disposition options. Projecting the net operating income and the impact on capitalization rates informs better decision-making. Don't forget to factor in recapture taxes, transaction costs, and other expenses. Ultimately, we choose the option that offers a stronger financial outcome given the current market and portfolio conditions. This comprehensive approach helps maximize property value and investment returns. When considering why to exit an investment property, it's important to recognize that disposition usually starts with a trigger rather than a fixed calendar date. The key is to watch for the moment when holding the property stops being the best use of your capital. One common trigger is the market peak. This is when pricing is strong, cap rates are compressed, and buyer demand supports premium value. Selling at this point can maximize your return. Another factor is tenant turnover. Lease rollovers can create a clean exit window before vacancy risk or re-leasing costs begin to increase, making it a strategic time to sell. Major repairs are also a significant consideration. If a property needs a large capital investment for repairs that won't be fully recovered in value, selling might be the smarter choice. Finally, capital redeployment is a key motivator. If you can earn a better return by reinvesting equity in acquisitions, renovations, or through a 1031 exchange, it makes sense to exit and put your money to better use. These four common triggers, market peak, tenant turnover, major repair needs, and capital redeployment, signal when disposition might create more value than continued ownership. Recognizing these moments helps ensure your investment decisions are timely and profitable. Here we have the income property life cycle, broken down into three essential stages. The first stage is acquire or build. This is where you purchase the property, secure financing, and position the asset to generate stable income. It's about laying the foundation for long-term success. Next comes operate and optimize. During this phase, the focus shifts to maximizing net operating income, or NOI. This is achieved through effective leasing, proactive property management, and targeted improvements that enhance the property's performance and appeal. Finally, we reach renovate or exit. Over time, properties age and the owner faces a critical decision. Either reinvest capital to renovate and increase the asset's value or exit the investment by selling strategically. This stage is crucial for maintaining or enhancing the portfolio's overall strength. Understanding these stages helps us make smarter decisions at each point in the life cycle to drive consistent value and income. Let's take a closer look at the fundamentals of capital gains tax, especially as they relate to income properties. When you sell a property, the profit you make is considered capital gain, but how that gain is taxed depends largely on how long you've held the asset. If you hold the property for 1 year or less before selling, this is known as a short-term gain. The key thing to remember here is that short-term gains are typically taxed at your ordinary income tax rates. These rates can be as high as 37%, which means a significant portion of your profit might go to taxes, reducing the net proceeds you actually take home. On the other hand, if you hold the property for more than 1 year, your profit is classified as a long-term gain. This is advantageous because long-term capital gains generally qualify for lower federal tax rates, which typically range between 0% and 20%. This lower rate can substantially improve your after-tax returns, making it more beneficial to hold on to income properties for longer than a year before selling or renovating. Understanding these distinctions is crucial when planning your property dispositions or renovations, as the timing can have a major impact on your overall financial outcomes. So, keeping an eye on the holding period can help you better manage your tax exposure and maximize your investment returns. Let's talk about the 1031 exchange and how it helps defer tax liability. Essentially, when you sell an investment property and reinvest the proceeds into another qualifying property within specific timeframes, you can defer paying capital gains taxes. But timing is crucial. If you miss the deadlines, you lose that tax deferral benefit. The process starts by selling what's called the relinquished property. This triggers the exchange. From that point, you have 45 days to identify potential replacement properties. You must formally designate these properties within this strict window. Next comes a 180-day total period to close on the replacement property or properties. You need to complete the purchase before this deadline to stay within the rules. Once you complete the exchange, the capital gains tax is deferred, meaning you preserve more of your equity to reinvest rather than paying taxes immediately. This strategy allows for efficient reinvestment and growth of your investment portfolio. It's a powerful tool for managing disposition and renovation of income properties while maximizing financial benefits. When we're looking at the like-kind requirements for a 1031 exchange, there are a few important points to keep in mind. First, the properties involved must be real estate, meaning both the relinquished asset you're selling and the replacement property you're acquiring need to be real property. This isn't about swapping stocks or personal items. It strictly involves real estate. Next, the properties must be held for investment or business use. So, you can't use property that's primarily for personal use or something you plan to flip quickly for a profit. The idea here is that the exchange applies to assets intended for ongoing investment or business purposes. Now, even though the properties must be of like kind, this doesn't mean they have to be identical. The price, location, tenant type, or even how the financing is structured can be different. Like kind really refers to the same general use class of property, not exact matching features. So, as long as the properties fall under the same broad category, the exchange can qualify. Understanding these requirements is essential to making sure a 1031 exchange is valid and compliant with the IRS rules. Here we have a case study comparing two approaches to managing income properties, a straight sale versus a 1031 exchange. First, with a straight sale, you get immediate liquidity, which means you receive cash right away. However, this triggers a tax event where capital gains and depreciation recapture taxes are due at closing. The process is simpler and faster, with fewer compliance deadlines, making it attractive when you need to reduce debt or exit portfolio quickly. On the downside, you may face lower reinvestable equity after taxes, which could limit the scale of your next acquisition. On the other hand, a 1031 exchange offers tax deferral by allowing you to reinvest proceeds into a like-kind property without paying capital gains taxes immediately, as long as you meet specific identification and closing timelines. The timeline is more complex, requiring you to identify replacement properties within 45 days and close within 180 days, which can create pressure. While this approach keeps more equity invested and supports portfolio growth, it requires flexibility to choose qualified replacement properties and involves more structure. This option is best when your priority is tax deferral and maintaining ongoing exposure to real estate investments. Each strategy has its trade-offs depending on your financial goals and timeline. Here, we're focusing on several crucial factors that impact the market analysis before an exit. First, absorption rates and the pace of leasing indicate how quickly available properties are being taken up, which directly affects demand and pricing. Cap rate trends and yield direction help us understand the return expectations and potential profitability of investment properties. Comparable sales and recent benchmarks provide context by showing what similar properties have sold for recently, giving us a realistic snapshot of market value. Tenant demand and occupancy momentum reveal how stable and attractive the properties are to renters, influencing cash flow and investment security. Finally, disposition and renovation strategies are key for maximizing returns before exiting income properties, ensuring we capitalize on market conditions at the right time. All these elements together help us make informed decisions for a successful exit strategy. When we talk about renovation in the context of income properties, it's important to recognize that renovation works best when it actually changes the income potential of the asset. Before renovation, the property might have limited income or outdated features. By updating the asset, we can reprice the revenue it generates. This means better appearance, stronger rents, and ultimately, a higher exit value when the property is sold or refinanced. The strategic outcome here is clear. Renovation can expand the net operating income before you decide to sell or refinance a property. This adds real strategic value, making renovation a powerful tool for improving the financial performance and appeal of income properties. On this slide, we're looking at different types of renovations and how each impacts the property's value and income potential. Renovations vary widely in scope and cost, and understanding this helps in making informed investment decisions. First, we have cosmetic renovations. These are lower cost improvements like painting, updating flooring, and landscaping. They usually range from about $5,000 to $25,000. While they don't involve major construction, they can quickly boost the property's curb appeal and tenant interest, typically adding around 5 to 10% in value. Next, functional renovations address systems crucial for property's operation, like HVAC, plumbing, and electrical work. These upgrades are more costly, usually between $20,000 and $100,000, but they offer a stronger value add, about 8 to 15%. Functional improvements help protect the income stream by reducing maintenance issues and improving tenant satisfaction. Lastly, structural renovations are the most significant investments. They include things like roof repairs, foundation work, and ensuring the property meets current code compliance. Costs here start around $50,000 and can go much higher. However, the payoff is substantial, often increasing property value by 10 to 20% or more. These deep upgrades preserve the asset's long-term worth and protect your investment. In summary, the scope of renovation you choose directly influences your payback profile and the property's potential for income and value preservation. Cosmetic upgrades offer a quick lift, functional improvements secure income, and structural work safeguards the asset's future. Here, we're looking at how renovations can impact the cap rate and overall investment yield. Before renovation, the cap rate sits at 5.2%, which reflects a property's income relative to its value in its current state. After we invest in $250,000 worth of renovations, including upgrades to units, common areas, and improving rent appeal, we see a significant increase in the property's net operating income, or NOI. Specifically, an additional $48,000 annually driven by rent growth and reduced vacancy. This improvement in NOI leads to a shift in the cap rate, moving it from 5.2% up to 6.8%. This 1.6 percentage point increase shows that the market values are stabilized, improved property higher, because it generates stronger and more reliable income. Ultimately, this means that the yield for investors improves due to higher NOI relative to property's value. In essence, the renovation thesis is that by strategically investing capital to enhance the property, we not only boost income, but also enhance pricing power and market perception, leading to better returns when a property is stabilized and potentially sold. Here we have a cost-benefit framework to help decide whether to renovate or sell an income property. The key factors to consider are market conditions, which can be weak or strong, and the property's condition, which can be good or poor. If the market is good but the property is weak, the recommendation is to renovate and hold. This means making targeted, high-impact improvements before testing the market. On the other hand, if both market and property conditions are strong, the strategy is a strategic upgrade to capture premium demand with minimal additional capital. When the market is weak but the property is good, it's best to hold and wait for stronger pricing while preserving income and net operating income. Finally, if the market is poor and the property is also in poor condition, selling soon is advised to leverage market momentum before renovation costs erode returns. This framework helps us evaluate the highest value move by balancing market strength and property condition to maximize returns. When evaluating expenses, it's important to distinguish between capital improvements and operating expenses. Capital improvements are investments that add value to the asset or extend its useful life. These costs are capitalized, meaning they're added to property's basis and may impact depreciation recaptured down the line. Examples of capital improvements include things like roof replacements, new HVAC systems, or major remodels. On the other hand, operating expenses are routine maintenance costs that keep the property running but don't add value. These expenses are currently deductible and include things like painting, minor plumbing, or typical repairs. Understanding this distinction is crucial when managing the disposition and renovation of income properties because it affects both your accounting and tax treatment. When you claim depreciation on a property, it reduces your adjusted basis in that property. This is important because when you sell, the IRS requires you to recapture that depreciation. Essentially, the tax benefit you received earlier by claiming depreciation is now taxed, usually at a rate of 25%. Here's how it works step by step. First, you claim depreciation over the time you own the property. This lowers your basis, or what you have invested in the property, for tax purposes. When you sell, the amount of depreciation you've claimed can't just disappear. It triggers a recapture tax. To put it simply, imagine you claimed $100,000 of depreciation. That $100,000 is then taxed at 25%, resulting in a recapture tax of $25,000. This amount is owed before you even consider any other capital gains taxes you might owe from the sale. So, depreciation recapture represents the tax created by the earlier depreciation deductions you took, and it's a key factor to plan for in property disposition and renovation strategies. When financing a renovation project, there are three main options to consider, each with its own advantages and drawbacks. First, using cash reserves is the simplest method. It has no interest costs and generally allows for faster approval, making it ideal for smaller, phased upgrades. However, it reduces your liquidity, which could be risky if vacancies or emergencies arise, and it ties up capital that might be better invested elsewhere. Overall, cash reserves offer the lowest financing friction, but come with some opportunity costs. Second, a construction loan supports larger repositioning or value-add projects. This option helps preserve investor cash for unforeseen contingencies during the renovation. On the downside, construction loans involve more complexity, including draw schedules, underwriting, and lender oversight, and the interest expenses can increase your break-even point. This type of financing works best for major renovation plans where the scale and scope justify the added complexity. Lastly, home equity lines of credit or HELICs offer flexible access to capital as costs emerge during the project, and they're often quicker to secure than traditional construction loans. However, variable interest rates can impact your returns, and using home equity means your collateral risk extends beyond just the property being renovated. HELICs are particularly useful when you have strong equity, and timing is critical. Each of these financing options has a distinct role depending on the size and urgency of your renovation project. So it's important to weigh these factors carefully to choose the best fit. Let's walk through a return on investment analysis for a property disposition and renovation example. We start with a purchase price of $500,000. On top of that, we invest $75,000 into renovations, bringing the total capital deployed to $575,000. The key benefit comes from the increased rental income. After renovations, the monthly rent lifts by $3,000. Over a whole period of 36 months, or 3 years, that adds up to $108,000 in additional revenue. To find the break-even point, we divide the renovation cost by the rent increase per month. So, $75,000 divided by $3,000 gives us 25 months. That means it takes just a little over 2 years to recoup the renovation investment through higher rent. Now, looking at the return on investment, We calculate ROI as the net gain from renovation, $108,000, minus the renovation cost, $75,000, then divided by the renovation cost. This gives us a 44% return over the 3-year hold period. Finally, if we annualize that return over the 3 years, it comes out to about 12.9% per year. This example clearly shows how strategic renovation can significantly boost income and increase the overall return on a property investment. Here, we're looking at the differences between a seller's market and a buyer's market, particularly in the context of selling or renovating income properties. In a seller's market, inventory is low, meaning there aren't many properties available for sale. At the same time, demand is high, so buyers are eager to purchase. This combination typically drives prices up and often leads to quick sales. Because of this, a seller's market is generally considered the best time to exit or sell your property. On the flip side, a buyer's market is characterized by high inventory and low demand. This means there are many properties available, but fewer buyers interested. As a result, prices tend to remain flat or even decline, and properties may take longer to sell. In these conditions, it often makes more sense to hold on to your property or focus on improving it rather than selling immediately. Understanding these market conditions is crucial when deciding whether to sell or renovate income properties. Let's talk about the exit strategy for managing income properties, focusing on the decision between holding and selling. The process starts with evaluating how your property is performing and then aligning your action with the current market conditions. First, ask yourself, are the rental fundamentals still strong? If the answer is yes, it's generally best to hold on to property and consider targeted improvements. Key indicators for holding include stable occupancy rates, potential for rent increases, and the ability for renovations to boost net operating income more quickly than you gain from selling. In this case, investing in value-add improvements makes sense to increase the property's profitability. On the other hand, if rental fundamentals are weakening, this signals it's time to prepare for an exit. Look for signs like softening demand, rising capital needs, or favorable tax and reinvestment timing that can make selling beneficial. When these factors come into play, marketing the property with a plan for disposition or using strategies like a 1031 exchange to reinvest proceeds is the recommended course. By carefully assessing these factors, property performance, market demand, and financial considerations, you can make an informed decision to either hold and enhance your asset or sell at the right moment to maximize returns. When planning for the disposition of a property, building a thorough tax checklist before listing is crucial. A strong exit strategy helps protect your proceeds by carefully modeling factors like adjusted basis, gain, depreciation recapture, exchange timing, and the overall impact on your taxes in the sale year. Before moving forward, there are 5 key items to verify. First, determining the adjusted basis starts with the original purchase price, including closing costs and any capital improvements made. From that, subtract all accumulated depreciation you've taken to date. Next, calculating capital gain or loss involves comparing your net sale proceeds against this adjusted basis. It's important to run both best case and conservative pricing scenarios to understand potential outcomes. Reviewing the 1031 exchange timeline is also critical if you're considering a like-kind exchange. You must identify a replacement property within 45 days of your sale and complete the exchange within 180 days. Assess depreciation recapture separately from your capital gain, as it can notably affect your after-tax proceeds. Lastly, planning the year of sale with awareness of your taxable income, other gains, and carry forward is essential. Work closely with your CPA and align this timing with your broader investment strategy to optimize tax benefits. All these steps together ensure a smooth, tax-savvy disposition of income properties. Here we have 3 important strategies for reinvesting proceeds after selling a property. First, the 1031 exchange allows you to defer taxes by rolling the proceeds into another qualifying property. This helps preserve your capital and lets your investment continue to grow tax efficiently over time. Next, geographic diversification involves moving your capital into stronger markets. By targeting regions with better rent growth, higher demand, or favorable demographic trends, you can expand your market exposure and potentially increase returns. Lastly, portfolio rebalancing means shifting your investments from one property type to another. This can improve your overall risk profile, enhance yield, or better align management resources, making it a strategic way to reallocate your assets after a sale. Each of these approaches offers a thoughtful way to optimize your real estate investments moving forward. Renovation isn't always the best strategy to maximize value, and there are clear warning signs to watch for. First, if the downside risks are structural, market-wide, or related to capital constraints, renovating might actually end up destroying your returns instead of increasing them. For example, if the market is in decline, both resale value and rent potential are limited, so investing in renovations may not pay off. Second, if the property has significant structural issues that exceed what can realistically be fixed or improved through renovation, the cost can outweigh any added value. Third, if tenant demand is dropping even after upgrades, it's a sign that renovation won't boost occupancy or rental rates as hoped. Lastly, if financing is either unavailable or prohibitively expensive, the cost of funding renovations can kill your profit margins. In scenarios like these, it's often better to consider selling the property as is or repositioning your capital elsewhere rather than pouring money into renovations that won't produce strong returns. When planning an exit involving income properties with existing tenants, it's important to carefully consider tenant-related factors. Tenants may object to a sale or feel disrupted by renovations, so managing these issues proactively is key. Successful exit strategies start with aligning lease renewals, communication, and construction timelines before any major marketing or capital improvements take place. There are 4 practical responses that can help navigate this process. First, timing lease renewals strategically helps protect against rollover risk by avoiding major listings or renovations during periods when multiple tenants are renewing leases. Second, incorporating rent growth provisions like escalation clauses or renewal terms ensures buyers see clear future upside, preserving value. Third, offering relocation assistance can reduce tenant resistance by providing support if renovations temporarily impact their access or use of the space. Lastly, scheduling gradual improvement phases allows renovations to happen in stages, keeping income flowing while enhancing property value. Together, these approaches help maintain tenant relationships and optimize the property's marketability during the exit process. Here we have an overview of renovation scenarios categorized by risk levels, low, medium, and high. Starting with low-risk renovations, these typically involve cosmetic updates that have an 85% success rate. They offer proven returns on investment and are easier to finance. One key advantage is that comparable properties support rent growth, and units can be upgraded with minimal downtime, making it a smoother process. You should proceed with this type of renovation when these factors align. Moving to medium risk renovations, success rates drop to around 60%. These involve functional upgrades, which can deliver good results, but outcomes are more market dependent. This means the demand must be rising, and vacancy rates should be manageable. Moderate lease disruption is expected, so timing and tenant considerations are important. Proceed when the payback period fits within your holding time frame. Finally, high-risk renovations carry a success rate of about 35%. This entails structural overhauls with longer timelines and financing challenges. You would pursue this option only if the property's basis is low, contingency reserves are strong, and there is substantial upside potential through repositioning. It requires careful planning, but can lead to significant returns if executed correctly. Overall, this framework helps assess renovation strategies by weighing risk against potential reward, timeline, and market conditions, guiding you to make informed decisions on when to proceed. Here we have a projection of the net operating income, or NOI, before and after renovation. Starting with gross rental income, you can see it increases from $420,000 to $504,000 post-renovation. Operating expenses also rise from $168,000 to $184,000, but the key focus is on the annual NOI. Before renovation, the NOI is $252,000, and after renovation, it jumps to $320,000, which is a $68,000 increase or a 27% lift. Now, considering the renovation investment of $340,000, the payback period is calculated to be 5 years, meaning it takes 5 years for the increased NOI to cover the renovation costs. This timeline is important because after year 5, the gains in NOI effectively compound, enhancing the property's income potential significantly. In summary, this higher NOI justifies the renovation investment, making it a financially sound decision in the long run. As we look at the exit execution timeline, it's important to understand the step-by-step process that unfolds over the months. In month 1, we focus on market analysis, pricing the asset, reviewing comparable properties, and setting clear exit targets. This foundational work sets the stage for a successful sale. Moving into months 2 and 3, the emphasis shifts to listing and marketing the property. This includes preparing the offer materials, launching outreach efforts, and qualifying potential buyers to ensure we attract serious and well-informed prospects. During months 4 through 6, we enter the negotiation and inspection phase. Here, we carefully review offers, negotiate favorable terms, and manage the due diligence process to address any concerns and maintain strong buyer interest. In months 7 and 8, closing preparation becomes critical. This involves clearing any contingencies, finalizing all necessary documents, and coordinating with lenders to ensure a smooth transaction. Month 9 brings the actual closing where the title is transferred, proceeds are settled, and the tax basis is confirmed. This is the culmination of months of coordinated effort. Finally, after month 9, we focus on post-sale activities, including identifying replacement properties, if using a 1031 exchange, tracking important deadlines, and reinvesting proceeds as part of the overall investment strategy. This comprehensive timeline ensures a structured and efficient disposition of income properties. Let's review the key takeaways regarding disposition and renovation decisions for income properties. There are 5 critical decisions that ultimately impact exit value, tax efficiency, and long-term returns. First and foremost, timing is paramount. Market conditions will largely determine your success, so understanding when to act is crucial. Second, 1031 exchanges can be a powerful tool to defer taxes, but they demand strict discipline and careful planning to execute properly. Third, before undertaking any renovation, ensure that the expected return on investment surpasses your hurdle rate. Otherwise, the costs may outweigh the benefits. Fourth, keep in mind that depreciation recapture can reduce your net proceeds when you sell, so it's important to factor this into your financial calculations. Lastly, always let tenant quality and broader market fundamentals guide your decision to hold or sell the property. By carefully weighing these factors, you can make informed choices that optimize your property's performance and value. Now that we've completed our analysis, it's time to focus on the next steps and create a clear, tax-aware execution plan. First, evaluate your current portfolio by carefully assessing each property's life cycle stage and its position in the market. This understanding will guide whether it's better to exit, hold, or upgrade a property. Next, model different scenarios by running analyses comparing holding and improving versus selling or exchanging properties. This will help you weigh value creation risk and the impact on your after-tax outcomes. Finally, execute your plan with a well-aligned tax strategy. Coordinate your disposition timeline with tax planning to effectively manage capital gains, recapture, and reinvestment opportunities. Following this structured approach ensures your income property disposition and renovation decisions are strategic, tax efficient, and aligned with your overall financial goals.